Assalamu alaikum. Have a good day. Welcome to Financial Management eLearning. We'll discuss strategic management accounting. So let's start. Today, we are going to discuss advanced capital budgeting topics. It is the strategic management accounting, module 6. And today we'll totally discuss inflation in the capital budgeting process, and our learning outcomes will be inflation adjusted discount rate, inflation adjusted NPV, nominal cash flow, real cash flow, effects of inflation and capital budgeting, solve the practical problem of capital budgeting with inflation, and calculation of NPV under non-adjusted inflation cash flow and adjusted inflation cash flow. So inflation in the capital budgeting process, that means capital budgeting or investment appraisal, is a process which anticipates expenses, writing of asset as well as cash flow in the future. Investment appraisal takes into account and various factors which impact expenditure in the long run. So inflation is one of such factors which impact investment and return. So inflation is one of the factors which impacts investment and returns. When calculating cash flow, it is necessary to include the effect of inflation. One way to do this, to direct the factor of inflation. So inflation affect capital budgeting analysis. It derives an increase in both revenue and cost, affecting in future cash flow of a project. Inflation is also one of the components of interest rates. It is already included in the market cost of capital used as a discount rate. So that means it derives an increase in both revenue and cost, affecting future cash flows of a project. Inflation is also one of the components of interest rates, that is, it is already included in the market cost of capital used as a discount rate. So inflation adjustment discount rate is, and we know the Fisher equation describe the relationship between the nominal interest rate and real interest rate and expected inflation rate. This equation is also used in capital budgeting to calculate the inflation adjusted discount rate. So it can be written as flow I plus Rn equal to I plus Rr multiplied by I plus I. So here where Rn is the nominal discount rate, Rr is the real discount rate, and I is the expected inflation rate. So the nominal and real discount rate can be expressed as follows: Rn equal to Rr plus Rr multiplied by 1 I plus I, or Rr equal to Rn minus 1 and I plus I. Both nominal and a real discount rate can be used in capital budgeting analysis depending on the method used to the account for inflation. Nominal can be used, also a discounted rate can be used. And one case you do the same in using the both cases. So inflation adjusted NPV two methods can be used to account for inflation when expected cash flow of a project are discounted to calculate the net present value. That is, there is two methods. One is adjusted cash flow to nominal value. Look, adjusting cash flows to nominal value. This method implies that all expected cash flows are adjusted to nominal values, and the nominal discount rate is used to calculate their present value. So adjusting cash flows to nominal value implies that all expected cash flows are adjusting to nominal values, and the nominal discount rate is used to calculate their present values. And another is adjusting cash flows to real values. So adjusting cash flows to real values. First nominal values, another real values. So expected cash flows of a project are adjusted to their real value and then discounted using the real discount rate. So in the adjusting cash flow to real value, it is the expected cash flow of project are adjusted to their real values and then discounted using the real discount rate. So both methods bring the same result. We'll prove with an example. So both method brings the same result of the project analysis. That is, the net present value of a project will be the same regardless of which method is applied. That means if we use adjusting cash flows to nominal values, or if you use the adjusting cash flows to real values, the result would be the same. The relationship between the nominal cash flow value and the real cash flow value can be described using the following equation. Look here. Nominal cash flow equal to real cash flow multiplied by T. So here, real cash flow equal to nominal cash flow divided by I plus T, where T is the number of period. Years is the annual inflation rate applied. The inflation rate has a different effect of components of future cash flow. Inflation rate has a different effect of components of future cash flows. For example, depreciation expense is not affected at all the inflation, unlike the retail price of products that directly affect to the sale amount. So effect of inflation and capital budgeting is that inflation affect discounted rate and cash flow. There are two factors on this inflation act. They are discount rate, cash flow, the inflation, cash flow, and inflation discounted. Look here, left side, inflation cash flow. To find the future cash flow with inflation, that is nominal. Look here, FV, future value of inflation, the nominal cash flow, equal to PV, present value without inflation, that means real cash flow, in number of period. So rule, future cash flow must include the effect of inflation. And inflation discount rate, if the cash flow include the following inflation, that the discount rate must include inflation. So the rules is that discount rate must include the effect of inflation. So inflation discount rate would say that the rule is that discount rate must include the effects of inflation, and inflation cash flow, the future cash flow, must include the effect of inflation. So where is a problem, that means a capital budgeting with inflation. Look here, if a company manufactured clipboard to the use of a small electronic device, the company is considering reducing its cost of automating some manufacturing tasks. The automation requires the installation of new equipment, the evaluation information of the net present value analysis of this investment is given below. Cost of equipment 72,000. Annual cost savings to be provided by new equipment 40,000. Use life of equipment 6 years. Salvage value for the 6 years there is 0. Cost of capital 23.2%. Look, cost of capital 23.2%, and expected inflation rate in cash flow associated with the new equipment 10%. So requirement is that what would be the net present value of new equipment if inflation is considered and inflation is not considered? And should if a company invest in new equipment? It is the question to you or question to me. So if we want to solve this problem, then we have to calculate the net present value if inflation is not considered. So first, we need to compute the real cost of capital. It is computed by, so real cost of capital equal to cost of capital minus inflation divided by 1 plus inflation. So cost of capital is 23.2, this one 23.2%. It is the cost of capital. So minus inflation 10%. Expected inflation rate, look, 10% here given in the cost. So this 10% is here divided by inflation plus 1. So here real cost of capital is 12%. Okay, so now cost of equipment, now that is 0 here, amount will get 72,000. This 72,000 is this 72,000 as given in the cost of equipment in the question, and a 12% factor is the 0 here, so minus 72,000, and to annual cost of saving 1 to 6 years 40,000. So how is come here? Cost of saving is saying here annual cost saving provided for the new equipment 40,000, and the life of the equipment is 6 years. So 1 to 6 years, that is 40,000 cost saving. And this rate is 12% factor. That means value of the present value. If you go to the sheet and with the here the present value of annuity of $1 in arrears travel, we see that is the cumulative of 1 to 6 years. If we add this, are 4.111. So here 164 is how come? It's come this figure and we multiply with that. So equal to is come 164 440. So net present value in PV is 92,440. So here, if inflation is considered, look here, this is 6 years, 1, 2, 3, 4, 5, 6. And cost of equipment just now 72,000. There's no inflation effect. So in the annual cost saving, the first year 40,000 The inflation price index number has been 1 plus 1, the 10% increase, 1 plus 1. So with that is come 44,000. How? It means 40,000 multiply 1.1 then equal to come 44,000. So with this 44,000, it PV factor 23, the cost of capital is here. Look in the question, that means there is cost of capital is 23.2%. So 23.2% is the factor cost of capital, which here look, this 0.82 comes how? That means 1 divided by 1 plus 1 to the power n, that means year 1. And next, year 2. Next, year 3. Next, year 4. Next, year 5, 6, this way. So this is come the all figures here. If we multiply that, then again 44 multiply with 0.812, then we'll get 35,728. So this way, year 1, 2, 3, 4, 5, 6, calculate total figures here. And if we add and deduct the cost of equipment, the initial investment, then we get net present value 92,467. So the difference is net present value computed with inflation. Without inflation is due to a rounding error, just rounding error. Look here, it's 92,440 is the 92,460. So 440, 460, just few amendments. So we can say that both methods giving us the same result. Look, so in these problems, number 2, should a fair company invest the new equipment? So what would be the answer? Answer would be that the positive net present value indicates that the project is acceptable. So a fair should accept the project. So, okay. Look another one. Calculation of non-adjusted inflation cash flow and adjusted inflation cash flow. Also same way we will see that both method would be the same result. Come here. FYR. What is the popular name to me, FYR. Company consider undertaking a capital project with the initial cost 30 million required to buy new equipment, and its life is 3 years. The other parameters of the projects are the current sale price is $30 per unit, and expected sale by the year, that means first year 2 million, second year 2.5 million, third year 2.8 million. The current variable cost per unit 21.60 per unit. So selling price is 30, but variable cost is 20.6. The current annual overhead cost 5 million. Here one, okay, 5 million. A company applies, this company applies the straight line depreciation method and zero salvage value. The market cost of capital 12.5%. The expected annual inflation rate is 2.5%. The marginal tax rate is 30% for this company. It is assumed that inflation will affect all the components of future cash flow except the depreciation. So, except the depreciation, other components are affected by the inflation, the future cash flow. Okay, so requirement is that calculate the NPV under non-adjusted inflation cash flow and adjusted inflation cash flow of the project of this FIR company. So let us start. Here, the non-adjusted and inflation cash flow are shown in table below. This is how it comes. Non-adjusted. Look here. It is the calculation. Sale for the first year, 2 million. Selling price, $30. So 60 million is the revenue. Look, sell 60 million. Same way second year, 75 million. Third year, 84 million. And total the variable cost for the first year, 2 million unit multiplied by 21.6. So it's come 43.2 million. This is the low, 43.2 million is the total variable cost. And overhead cost is that we fixed was 5 million is the same for the every year. And depreciation, what would be the depreciation is the straight line method. When the straight line depreciation method apply, the depreciation expenditure is the same of each year and amount 10 million. Because look, it is the capital 30 million. So this 30 million divided by 3 years. So each year 10 million is the depreciation. So this 10 years, 10 million, 10 million, 10 years. And earning before tax, how we get it? From the sale amount, we deduct the total variable cost, overhead cost, depreciation expenses. Then we get earnings before tax, 1.8 million for the first year, 6 million for the second year, 8.52 million for third year. So tax expenses, that is, how much the tax rate? The tax rate is 30%. So 30% of earning before tax, that means 18 million multiplied by 30% or 0.3, then we get 5,40,000 the tax expenses. So if we minus tax expense, then we come net income. What is net income? 1.26 million is the first year's income. And cash flow, what would be? With this net income, we have to add the depreciation expense because it's a non-cashable item. So 1.26 million plus 10 million. So it's come first year net cash flow 11.26 million. Same way, the year 2, 14.2 million, 3, 15.964 million. So it is the net cash flow. So come here, this net cash flow, this we calculate here, but then with the depreciation, and we would adjust the cash flow. See, this cash flow is come 11. So okay, this cash flow, and now we should adjust cash flow inflation rate, calculate inflation adjusted NPV. So how adjust? Look here, the real value of the sale, total variable cost and overhead should be adjusted to the nominal value. For this, 60 million is the first year sale. Here, adjust with the inflation. That means 1 plus 0.025 because inflation rate is 2.5%. So 2.5% come here. This is the 2.5%. And the first year, so it's come 61.5 million. Same way second year, third year, this figure is here 61.5 million, 87.79 billion, 90.45 billion. And total variable cost, same way adjust. So total variable cost and overhead cost and adjusted nominal value in the same manner, just like 1 plus 0.025 and 2 to the power 1, 2 to the power 2, 2 to the power 3. So this so is come the figure here. So 44.8 and overhead is that, but depreciation not adjusted. It is the 10 million. Okay, so earning before tax is 2.095 million in the first year, and tax expense 30% of 2.09 million comes 6,28,500. And if we deduct from the earning before tax, then we get net income 1.466 million. With this figure, if we add 10 million is our depreciation, then we'll get net cash flow 11.466 million. Same way, second year 14.767 million, and third year 16.96 million. So it is the inflation adjusted net cash flow. So come here. So now you can calculate the inflation adjusted projected the market cost of capital as the nominal discount rate, because it already reflected the inflation. So NPV 30 lakh is the investment in the initial stage. So first year's adjusted net cash flow, inflation adjusted net cash flow 11.4665 million. Look here, divided by 1 plus 0.125, that's been inflation rate for 2 to the power 1 this first year, and next second year and third year, then we get 3.772 million. It is the NPV of inflation adjusted NPV. And let's adjust all the cash flow to their real value to provide the both method bring the same NPV. Cash flow adjusted to their real value are given in the value. Look here, cash flow adjusted, come here 11,466, and 60 sale, variable cost is what? 60, variable 43 to here 43. This previous, well, first we seen it, this come 11.18. Now depreciation expense for the first year, the 10 million comes to 9.7 million the real, and second year is comes 9.5 million, third year 9.2 million. So we should also adjust the market cost of capital to the real value. So real discount rate 12.5% minus inflation rate 2.5% divided by 1 plus 0.025. Its come real discount rate would be 9.76%. So this 9.76% is here 9.76. 1 plus 9.76. So NPV of real discount rate is count the same figure 3.772, 3160. Look here, 3.772 is the NPV of inflation adjusted NPV, and it is the real discount rate NPV. So as we've seen, both methods are given same net present value of this product. So we can say that each method can be used to capital budgeting, analyzing provided cash flow, and the discounted are the properly adjusted to the inflation rate. So what we discussed today, we discussed here inflation is the one of the such factor which impact investment and return. So inflation affects capital budgeting analysis. It derives an increase in both revenue and cost. And inflation adjusted discount, the Fisher equation, we are using nominal interest rate and real interest rate, and the nominal and discount rate is this is the formula, and a nominal and real discount rate can be used to capital budgeting analysis depending on the method used to account for inflation. And the inflation adjusted NPV, and here two methods, adjusting cash flow to nominal values and adjusting cash flows to the real values. The both methods bring the same result in the project, which we have seen in the two problem solving. And nominal cash flow equal to real cash flow multiplied by 1 plus I plus multiplied by T. So real cash flow equal to nominal cash flow divided by 1 plus I T. Here T is the number of period. So the effect of a rate of discounted affect the component of future cash flow, and the effect inflation capital budgeting in. That means the rule is that future cash flow must include the effect of inflation. And in the inflation discount rate, the rules is that discounted rate must include the effect of inflation. So we have solved this problem, capital budgeting with inflation. Here we calculate the NPV with the inflation considered and without consideration. And another problem, we solve the calculation of non-adjusting inflation cash flow and adjusted cash flow. And here we have seen that the NPV of both method as the same result, being the same result, and sometimes it can pure rounding difference only. So it's for today, and we'll meet inshallah near future. So till then, take care. Allah Hafiz.